You're listening to Real Investor Radio with Fuhr and Jack BeVier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Well, hey, welcome to Real Investor Radio. I'm Fuhr, back again with Jack BeVier. Thanks for joining us today. Jack, how are you?
Doing good. Great to see you.
We were just talking about Christmas prior to. Jack's feeling slightly under the weather. He's going to go get himself a sweet IV today. You are.
I've done the IV after Vegas, just to keep it going because, 3-4 days in Vegas is just too much. So halfway through, you got to call a timeout and go get that IV to keep it going, head to the pool party later. So I've done that before and it was super helpful. I've never considered it an actually healthy context to make myself from a restorative point of view to get me back to normal from being actually sick. So, but it's worth, I'm intrigued. I'm going to give it a shot.
Well, as you know, Jack, I'm an old man, 56 years old, and I still sing in a rock and roll band. And tonight we have a big gig. And I never know what voice is going to show up at this age, Jack. Never know. So yesterday I went and had my second IV of the week, and I'm feeling like I could take down a lion right now because I got packed with vitamins yesterday. So got a lot to talk about today, man. And as a backdrop to what we want to talk about in terms of the sort of the 5-year going down, just Fed lowering rates and sort of an outlook for the next few months and maybe 24, I thought we could start off talking about what we're seeing over the last month or so in housing. So I've got a few reports here from Wolf Richter, Jack. And first one here was done on December 19, 2023. You guys can go to wolfstreet.com, I believe it is. And residential construction gains steam ahead. Single family starts jump to the highest since spring of 22. Multifamily rises from the ashes. This guy has a way with words. He is. I wouldn't call him as bullish on the market as others, but confronted by mortgage rates that make it tough to sell houses at May of 2022 prices. You're gonna love this one, Jack. Home builders have adjusted. And in their quality reports have spelled out how they're going to do it. Building smaller houses, Jack.
There you go.
Consumption. They're de-amenitizing houses with cheaper appliances, countertops, etc. And most of all, they're buying down the mortgage rate. Jack, I've seen some of these builders going down to 2.9% for a teaser 1 year, and then the rate starts creeping up over the next, I think, 3 or 4. Have you heard that? And if so, we speak about that?
Yeah, that's become a very popular incentive that builders are putting in place to get folks to qualify, right? It kind of exploiting the idea that the consumer believes that rates are going to come down over the course of the next couple of years. So, the whole marry the house, date the rate thing. And builders, in order to prevent values, in order to avoid price drops, right? Which then you have to, once you set a comp within your subdivision, you're married to that comp for the rest of the subdivision. So rather than do that, they've been finishing basements, giving away free decks, and offering rate buy downs to keep that V number where they want it so that they don't cannibalize their appraisals throughout the rest of the subdivision. We've actually even ripped that idea off. Basically, we happen to own a mortgage company, and we also happen to own a flipping company that will probably sell about 80 houses over the course of the next 12 months. So, and we can do consumer residential mortgages. We don't do very much of them. We don't do very much of them at all, but we can. We're licensed to. And so I actually put in a builder incentive program in place for our flips that we're selling so that we can offer rate buy downs just like the larger builders are, which, my thought was, hey, that's an interesting competitive advantage that most flippers can't offer. And in a little bit softer market, why not pull that tool out of the bag? So I think it's a great idea. It'll be interesting to see with the new, because mortgage rates have come down a little bit over the past month or so, what effect that has, and which of the incentives the builders drop, if any, first. Is it the deck? Is it the finished basement? Is it the rate buy down?
Hey, let me ask you this. I saw some builders the other day that are offering like that for 1 year teaser 2.9%, 3%. As a guy who writes millions of dollars of mortgages a month, what in the heck must that cost, even at their cost of capital these days, Jack? What must that cost them to buy down that rate to 2.9% for a year for the
Well,
builder?
it's
What are they giving up in their overall profit on that?
yeah, it's pretty much a 1-to-1 buy down, right? So like if mortgage rates today are let's call it today 6.9%, and you want to buy it down to 2.9%, that's just 4 points. So it's essentially it's actually less than 4 points of seller help. So if you were going to say,
Mm.
hey, I got to give 4% of seller help, that you're giving 4 points on the full purchase price. Whereas if you're
Mhm.
working with somebody buying $1 million house and putting 25% down, you're offering 4 points on 75% of that purchase price. So it's a little bit cheaper than seller help, but the math's pretty easy. It's like a straight buy down. Now,
Okay.
where the math gets a little bit more complicated is when a builder offers a 30-year buy down, not just a 1-year buy down or a 2-year buy down or a 3-year buy down, but a 30-year buy down. That's when you actually have to talk to the loan buyer and say, or look at what the loan buyer rate sheet looks like.
Mhm.
And right now, for example, in DSCR, the buy down, and I think it's pretty similar in resi consumer mortgage right now as well, is 4 or 5 to 1. So if you wanted to buy the rate down by a full point for the 30 years, it'll cost you at least 5 points of that
Mm.
mortgage, 5% times the mortgage amount to buy that rate down permanently.
Wow. Okay. So it goes on here to say that the contract prices of new houses have dropped by about 18% from a year ago, while sales volume was held up, which I thought was interesting. The next story here was here come new listings of existing homes. Price drops further. Demand remains at collapsed levels. This guy loves the word collapsed levels. And it's very much bearish here. But the national median price of existing single-family houses, condos, and co-ops whose sales closed in November of this year dropped to about $387,000, down 6.3% from the peak in June of 22. 2023 is the first year since the housing burst when seasonal high in June was below the all-time high a year earlier. In other words, June 23 was the first lower high since the housing bust in 2008.
Yeah,
So,
so something about that math that's going to get muddy here.
mm-hmm.
Like looking at the median price or the average price year over year is fine when we're comparing the same housing stock year over
Yep.
year. But as you just pointed out in the previous, article, that if builders are building smaller houses and that's what's available, well, then the median price is going to go down, even if the cost per square foot stays the same, even if the same store, right? It's like same store sales versus gross sales. Even if the same house price is flat or goes up, you may still see a median price decrease. So that's where, I mean, and now economists know that, right? And so like there's indices like the Case-Shiller index, which is a same store index, right? It compares the average sale of what it attempts to find the same house prices and compare those over time. So you can actually get more of an apples to apples comparison of what your house is going is your house going up or going down, as opposed to like the whole market, which is less interesting.
Agreed. And
That's
I
what
don't know if
consumers care less about. Yeah.
there's always a slowdown in the fall and winter too. And I don't know if those numbers are seasonally adjusted or not. So,
Right.
wolfstreet.com, Wolf Richter, he's got some great stories on there. I'd advise everybody to go check it out. Jack, you reached out to me after IMN in Scottsdale. Check out our last episode on our IMN wrap up. You reached out to me regarding the rate drops that we've been seeing lately. And we thought we would do a riff on that today. And I have some things I'd like to throw in. But yeah, why don't you start us out what you're thinking?
Yeah, so the big news was last Wednesday's Fed meeting. The Fed, as anticipated, did not move their target Fed funds rate up or down. But what was of great surprise was the commentary from Powell was remarkably dovish, given, he talked about that the Fed anticipates that they may have 3 rate cuts during 2024. Of course, he didn't speak to the timing of those rate cuts, which is an important important factor. But you saw the market, some kind of bears in the market in Wall Street pricing as many as 5 or 6 rate cuts during 2024, which is really kind of like, that was really the bear case for a hard recession. And I guess surprisingly, Powell came out and said that, or indicated that they expect 3 rate cuts. Now, given how hawkish Powell has been for the past 2 years now, right? He's been banging the drums that there's going to be pain. We're going to need higher rates. We need to get inflation under control. That's the main priority. And he's been banging that drum, even when, no one wanted to hear it. And he just kept banging that drum, and then he just kept doing it. Right. And we all just, he really, rose rates into very restrictive territory.
Mm-hmm.
So to hear him come out with some actually dovish comments and talk about rate decreases this year, right? Before, he was just saying like it's going to be higher for longer, and then he put a time frame around not just a rate decrease but 3. The market just went nuts. Like, the stock market took off. Mortgage rates tightened up significantly. The 5-year came down. The 10-year came down. All the bulls for housing are like,
back to the races.
Jumping up on their desks and like dancing and doing the, I told you so, nanny nanny boo boo, the sky's not falling. And so like it was a real real excitement, like, hey, the worst is over, it's behind us, the war is over, right? Like the war against the American economy is over. We've put the worst of it behind us, and it's going to be all blue skies going forward. It may take a little while, but you know what? It's going to get better, and we should all be happy about that. So, and we've seen over the course of the past month, even before this meeting, mortgage rates were starting to drop, and then they dropped more in the wake of these comments, the Fed's comments. And we've seen a 100, between a 75 and 150 basis point decrease in mortgage rates, depending on the product that you're looking at, which is a huge, that's a huge decrease.
Phones are ringing off the hook.
Yeah. Now, I'm sure we've still seen they're still high, very high relative to the past 5 years, but some relief, right? And we've definitely seen it, as you just mentioned, in our borrowers who are borrowing DSCR loans, because that product is directly tied to the 5-year. And so the 5-year came down below 4% for the first time in, I don't know, a year. Feels like a year and a half. It
stands at about 3.86 right now, Jack.
Yeah, which is much better for mortgage rates. I think we can print we're printing like 7s, like low 7s. If it's a lower LTV deal, like high 6s right now, which,
I haven't seen any high 6s yet, but I'm anxious to get a few of those. Mostly 7 and 1/8, for lower LTV.
So if we, that starts to work, it kind of starts to work again, like it's not so brutal anymore.
I think what it does, Jack, is it gets people sort of more optimistic, a little exuberant, they're feeling a little relief. Yeah. So,
and so I think we're seeing already a release of some pent up demand, for the investors who were like, I'm not doing it, 8.5, not doing it. We saw some stuff getting into the 9s, right? If it was like a weird product or a low ratio, like low DSCR, like those rates were getting up into the 9s and 10 range, which was crazy, right? Like why, that you're only taking that if you need the money, right? Because it's cheaper than hard money. But so we're seeing definitely a release of pent up demand, and I've got some thoughts on whether people who are still on the sidelines should continue to wait or not. because they're headed down, right? But like, what are they going to do next week, and where are they going to be 30 days from now? That's a different question, right? So anyway, so that was the the big news last week. It was the Fed commentary and a lot of like exuberance from folks who were like, hey, we should see an increase in transaction volumes. These rates actually work a little bit better if we're trying to build our rental portfolio. And if you're a flipper, it could be, there's hope now, which is a word we haven't used in a while, or it's been a 4-letter one for a while, that it could be a strong spring. So that's kind of the vein of stuff that I, wanted to chat about a little bit. That's kind of the backdrop there.
Mm-hmm.
So I think that, so here's my, I prepped you for, I haven't told you about this, but I prepped you that I had a conspiracy theory that I can't help myself. I gotta,
I love a good conspiracy theory, Jack.
Yeah. And I'm not generally a conspiracy theorist, but I'm sure most conspiracy theorists preface their conspiracy theories with that statement, though.
Always, with all due respect.
Yeah. So something that really just like I'm scratching my head about is that Powell's comments were, he was higher for longer, higher for longer, higher for longer. There's going to be pain. And out of seemingly left field, from my perspective, out of seemingly left field, he goes pretty dovish and even starts to talk about 3 rate drops. That is, to me, a remarkable reversal, of course. And if your job is to be the guy at the tiller of the American economy, keeping inflation down and unemployment down, yanking the tiller is the worst thing that you can possibly do, right? Like, it scares everybody. A whole crew doesn't know what's going on. And though they're happy, everyone was happy with this news. And so everyone's kind of like, oh, really? Like, we're going to get 3 rate hikes this year? Like, well, that's great. Like, certainly the housing market is very happy to hear this positive news. I'm skeptical that he came to these conclusions, that they came to these conclusions on a purely quantitative basis. Because why wasn't he saying anything along these lines at the last meeting? And how did you go from higher for longer, like just screw you, higher for longer, to 3 rate cuts in the next 12 months? And I hate to hear myself say this, but I feel like there's like some politics going on here. And we've started to see inflation come down. It was down again. PCE was down another like 1/10 of a point, but it's not in the 2% range, which was what he was banging the desk about 2 years ago. And jobs have continued to be strong, but the consumer continues to weaken. And so now we had a really nice like headline GDP number for 2023, but the forecasts for 2024 and 2025 are much lower, right? There's still conversation as to whether we might go into a technical recession. And so I just feel like it was almost a little, if he believes it, then it was a little, I think, irresponsible to give comments that were going to be received with such exuberance by the market. Like, better to let the market come to that conclusion, and then and then in June, right? Like, he's not saying at the next meeting we're doing rate cuts. He was pretty clear actually to not say that. So why are you talking about something that's going to happen 6 months from now? 6 months ago, you didn't know, like, the 6 months is an eternity right now. So why the hell are you talking about 12 months from now? It just seems other than
did you want me to answer the question, or are you going to answer it for us?
I'm gonna get there. I'm building up to my like,
love it, crescendo.
Yeah. Other than if there is a recession in America in the 3rd quarter of 2024, the incumbent is going to lose. I don't care if he is red, blue, purple, yellow, or green. He is going that individual, man or woman who's in office, is going to lose if the country is in the midst of a recession come November.
It's the economy, stupid.
It's the economy. It's always the economy, stupid. And so, frankly, Biden has been getting his butt kicked from a poll's point of view. And just more concerns about his ability as a president. And I'm not trying to make this a political
Of course
thing,
not.
but frankly, it doesn't matter who's in office. Like, this timing just raises my freaking eyebrow.
Agree.
And now I don't bring that up because of the political aspect of it. I bring it up because running my business, the question that I need to answer, that the hard look in the mirror that I need to take is, do I believe it? Like, do I believe that the economy is ready for 3 rate cuts? Do I believe that mortgage rates should have come down 100 basis points in the past month? And because of my because of my skepticism on the political side of things, and my concern that this is not purely a data-driven decision by the Fed, I have some reservations that rates are going to stay at these lower levels. I could see us, if we already saw the stock market take off on this. If the consumer starts to feel a little bit better and start spending again, and businesses start to feel a little bit better and start increasing prices because I think consumers are willing to spend it, we could have inflation slide back up. And when that happens, if and when that happens, the Fed will be forced to say, hey, yeah, never mind. Like, we're going to follow the data, right? Like, all of a sudden they're going to be like, oh, wait, never mind. We're following the data, and the data indicates that we can't decrease rates this year. And then mortgage rates come back up because everyone's like, yeah, you know what? We're not out of the woods yet. Let's get past this election. And certainly an election year is, a time of like considerable risk, right? Because you don't know what's going to happen. So, like, why would we be seeing tightening going into an election year other than it being a bit manufactured? And so I'm refinancing some houses. That's what I'm doing, is because I don't really believe that we should have seen a 100 basis point decrease in mortgage rates. And so that's why I'm bringing this up, is the business implication for me leads me to be skeptical of these rates. And I think that it may be a little bit mispriced, particularly going into the risk environment of the next 12 months. And so I think it's probably some good debt to add on balance sheet right now. Obviously, I'm talking my
before
book
we
a
get
bit
to this sort of
do loans, but yeah, go ahead.
Sorry, man. I want to come back to how does it affect real estate investors, and maybe how we should prepare for it now, 30 days from now, 100 days from now. But a couple of things that I thought were interesting with what you were saying there is, is the decision based on data, or is it based on giving us some sugar in an election year where the incumbent is really, really compromised, and is losing in almost every poll, including those that tend to skew more towards the incumbent side, right? And again, I think we should be very, very clear here. Let's be adults here. This is not a political discussion. It is purely factual. Let's face it, Biden is really taking some wind in office right now, one of the historically lowest approvals of any president. And, I think they're doing all they can do to keep him in office, including, lawfare against the other side. So election year tactic, it's not hard to take that leap, Jack. So I can't disagree with you there. I wonder, though, Jack, about like some of the lagging indicators that we might not be seeing yet that that could rear their ugly head and maybe not have the soft landing that I think the Fed is kind of signaling that they want to engineer here.
What are you thinking about?
I think we've seen some layoffs. I wonder if more are coming. I think that food prices are still very high, which I don't believe are considered in PCE. Housing is still ridiculously unaffordable, which is not considered in PCE. I just don't see how the consumer, Jack, is feeling any relief from from the Fed move, or frankly any over the last several months. I don't see how the consumer is feeling this great economy that the White House and others tell us that we're experiencing right now.
Yeah, I completely agree with that. And then particularly on the housing side, okay, great, mortgage rates are down a little bit, but So we're gonna release some pent up demand, right? And by the way, for everyone who's flipping a house, or even maybe even considering buying a house right now, that doesn't happen like the next week, right? Like mortgage rates have been dropping. There was some very positive data last week, for, coming out of the Fed's comments. The market is down. The mortgage rates are down even more, and so you go home, you're getting ready for the holidays. You have conversations with the wife and the family about, hey, do you want to get back out there? We can now, I called the mortgage guy and we can qualify for that house that we want in that school district that we want now. And maybe we should get back out there. And then in January, you start looking at houses. You get your pre-approval letter. You start, you find your real estate agent, call them up, start looking at houses, look at stuff, and you put something under contract in the end of January. So we're not going to see a spike in activity from a housing contracts point of view for a month. We're not going to see transactions happen as a result of this decrease in mortgage rates for 2 months. Maybe you see a little baby spike in refis 30 days from now, but there's still not a whole lot. The refi volume is anemic still, even at these, even with a drop. Like there's a huge spread, right, between what most people's mortgage rate is and where they're at today, even with this drop. So there's going to be a lag. It's going to take a little while for us to really discover what the actual impact on consumer behavior is. Now, in the same in the same vein, there's no new supply happening here, right? So like, even if these mortgage rates come down enough to make someone who has a 3.5% mortgage move to the other location that they really want to be in, and they can, and at 6.5, yeah, screw it, we'll do it. It's not, we're not happy about it, but we'll do it. And they make that decision. That's one purchase, one sale, right? But it's neutral from a supply point of view. Whereas the demand that this is going to release, the pent up demand that these lower mortgage rates is going to release, is for the first time home buyer. And the first time home buyer doesn't add any new inventory to the market. And so we're going to see supply. I think we're going to see inventory go down.
Did you catch that webinar the other day with Altos?
I didn't. Update? No, I love that though. I love Altos, but no, I didn't see it.
I did catch the webinar, and they're predicting sort of a sideways market next year, maybe a rise of like 6-8%, but
in prices,
nothing, sort of a sideways slog up, down, up. Yeah, in prices. But definitely no massive increase in inventory. They're not, defaults, foreclosures. There has been an increase in foreclosure starts, which tend to manifest itself 30 to 45 days later, which they're watching, but it's still, relatively low. So the feeling I got was, hey, this is the market we're in. Consumers are starting to sort of get used to these rates. And so they're saying to themselves, this is what the new thing is. So I guess we got to get used to it. While many have sort of lost hope that we'll ever be back down in that 3% again. Their other feeling was, all of this is predicated on a recession. So they're still sort of wish-washy on whether or not that would happen. I do have a friend that works pretty high up at Visa, Jack, and he was talking about sort of the analysis that's come out of their department there, and they're predicting no recession next year. Sort of a very, very easy soft landing. And when I say this guy's pretty high up, he's pretty high up. So he gets pretty good analysis and data. So I thought that was interesting.
Hey, let's talk about
and Visa would know.
Yeah, right. That's their core business. So like, let's talk about extrapolation, what you just said about home buyers coming back into the market, right? So they get their, these new mortgage rates. They're like, hey, I like that house. And then, those houses that are out there on Zillow. And so they start to look at stuff. I think that it's very possible that we find ourselves as a flipper, I think this matters to flippers, in an early spring market, because with the new pre-approval that you just got, like yesterday, the sooner you get a house under contract, the more you actually capitalize on your increased purchasing power based off of that lower rate. If you wait until March, April to start looking at stuff, when everybody starts doing that, you're just going to give it all back in paying more. Like, I think we're going to see another low supply, multiple offer spring. And as a result, another 5+% increase in housing prices. And so if you're the guy putting a property under contract in May, you didn't take advantage of the lower interest rates. Whereas if you do it in January, February, while the sellers are still, well, the sellers are still like, not used to getting full price in a week and actually like really psyched about that right now. I think those folks may actually capitalize on the increase in purchasing power of the lower rate. But by May, those consumers will have given it all back in housing prices. Now, that's good if you're a flipper. It's good if you're a flipper because you either get, full price a month from now or full price plus 5% 3 months from now. So that's still probably work. I think it's going to be a good spring as flippers go. But as home buyers go, I think that they're on the clock to take advantage of today's seller sentiment before showing activity starts to spike up 30 days from now.
Yeah, I think the big talk here that I'm, the sort of the sentiment around the interwebs that I'm getting is lower rates, even at the rates that we're seeing now, is going to unleash, all of this pent up demand. And it's going to happen quickly, thus increasing home prices even further on a very supply constrained market.
Mm-hmm.
I don't, it's still a let's speak directly to the guys who listen to our show, that, not the home buyer, but the investor. It's still a really difficult time to be an operator, Jack, right? I mean, the cost of a deal these days, insane. The cost of a lead. Talk about quickly, maybe a slight pivot here, obviously, but let's talk to those guys and, with regards to sort of how they're operating over the next, few months.
I think that landscape has remained difficult because we haven't seen this spring happen yet, and so frankly, I'm optimistic as a flipper. I'm optimistic about the spring, much more optimistic than I was a month ago. The flippers have been operating in a high interest rate environment where their cost of capital is high. Materials costs have come down some, but not a ton. Labor hasn't been broken, right? So labor is still elevated, and so you've gotten a little bit of leverage back on your contractor because he doesn't have quite so many jobs, but he's far from like cutting you a deal to keep working, to keep guys busy. And then deal volume is still the deal volume is still like the big driver there, where like the cost of acquisition of a deal and the energy that you have to spend as the owner or the acquisitions person to find deals is still very, very difficult. I think it's softened over the past 90 days a little bit, but now I think it's going to get harder again. I think that aspect is going to get harder again because Powell has introduced some hope through these, through his comments, which led to lower mortgage rates. And so folks who may have been thinking about going and getting a day job, maybe they hang on, maybe they're like, hey, you know what, honey, we're going to make it through this. We just, it's 3 more months and it's going to be a great spring and we're staying full time. Right now,
I know a guy that got a day job, Jack.
And it's what you got to do, it's freaking hard. So, and the day jobs are hard. Anyway, I think that certain things are getting easier, certain things are staying harder or getting harder, and certain things are going to get harder. So I don't think that it's going to be like, selfishly, I was hoping that this didn't happen yet because I was selfishly, right? Like just hoping that some more competition was going to disappear from the market to increase flipper margins, because as competition drops out, there's fewer bids, and on average, you're able to make a little bit more on the deals that you do find. So I'm a little like, I think margins are going to be tighter, but I also think it's a less risky environment as a flipper. So going into the spring,
I'm making my Christmas list for Jack, and it is all I want for Christmas is more distressed inventory.
Yeah, I hate to be
competition.
Yeah, I hate to be that but hey, that's the market, right? Like it's a competitive market. I like to compete. So, I do love a bit of Schadenfreude, right? When my competition is struggling a little bit, I don't mind it. I don't mind it.
So back to Powell, and we'll finish up here. So one of the things that I always I guess I find very interesting in the macro side, Jack, is how does a country, a post-industrial country, survive when you've got rising debt? We added $1 trillion of debt in 1 month, Jack. So by the end of this month, we'll be up to $34 trillion of national debt. And back in March of 23, you had the collapse of Silicon Bank and Signature Bank. That was March 10th and March 12th. On March 13th, the Fed introduced what was called BTFP, the Bank Term Funding Program. And I think, Jack, that part of the Fed's move not only has to do with it might have a sort of political side to it, but I think banks are really, really hurting right now, and no one knows about it. If we polled 99% of investors, and I think even some of the better investors out there, Jack, I bet that none of them would have heard of BTFP, and the fact that banks have borrowed over $400 billion since March of this year to backstop their long-term debt with, I guess, shorter-term debt from the Fed. So that balance now, they are paying the balances back, which I guess is some good news. But it still sits today at around 120 billion. It floats up between 114 and 130 billion at any given time that banks are borrowing from the Fed to backstop their losses. So that's part of what I see with Powell. He's like, oh, wait a minute here, man. These high rates are killing these banks with this very low long-term debt. What are your thoughts there?
I think that the banks, as a real estate investor, we've seen the banks just receding, right, over the past 9 months now, and just pulling back and pulling back. I think largely the commercial real estate concerns that are still unrecognized to a great extent. And so that's also this next shoe that that hasn't gotten as many headlines recently, right? That it was a big deal the past year to talk about commercial real estate, but then it got kind of quiet about commercial real estate the past 60, 90 days. And it didn't get better, right? Like it hasn't gotten any better. So it's still largely unquantified. And so I think a lot of the banks were borrowing that money to backstop their balance sheets so that they could set up specific loss reserves to be able to shed some of this commercial real estate loss exposure that they have. And you haven't seen, with this kind of like, we may still be going into a recession or at least a lower growth environment. Back to your comments on the consumer, right? Like the banks live or die based off of the strength of the consumer. If the consumer's got a bunch of cash, they put it in the bank. The bank is able to use that money cheaply to go make loans at higher rates, and that's how they make money. But right now, you've got sustained high deposit rates. Still, I don't know if deposits are shrinking or flat right now, but they're not up. Mm-hmm. And still an unquantified CRE exposure. So I agree. I think banks, I wouldn't, owning bank stock right now is not great. And I don't think that it's going to get better in the short term about that. And that's like, I agree with your point about that's a better connection to what's really going on in the economy than the stock market. For example.
I mean, it's the oil that greases the skids. It's very consumer based. If consumers continue to hear about banks failing, and I think there's just a really, really negative outlook and sentiment that there's a pall against people's sentiment in an election year as well. And I think so. I think that banks are hurting way more than people are letting on, and as they begin to fail, the Fed's not going to be buying these things. They're going to be selling for pennies on the dollar to JP Morgan. And so I think we'll continue to see more consolidation in banking over 2024 without it hitting the news.
I hear that. I think that's probable.
I just don't know if, and I think the ramifications of that are long-term bad for the consumer and for the country.
Yeah.
When you've got essentially four or five banks that own all of the banks, right? And they're buying up assets at pennies on the dollar, which is great for us, as investors buying things for pennies on the dollar, but not necessarily for banks. So, yeah.
Yeah. Haven't seen as much I still feel we're early on the whole commercial real estate side of things. Like either those deals are, I mean, the feedback that I've gotten when I've gone to conferences and asked this question directly of those banks is that a lot of, deals are getting punted. If someone's paying, the deal's getting restructured. It's a blend and extend, mentality. No one wants to take the loss. It makes the business it makes economic sense for the bank not to take the loss. It makes economic sense for the general partner of the fund not to have to tell his LPs that they have to take a loss. Like no one really wants to restructure to foreclose on the asset and resell it at and be and have to go do price discovery and figure out where market is for a office building in Wichita, right? Like no one wants to know the answer to that question.
Mm-hmm.
So you just, clip the coupon that you can, and if the operator is continuing to do the best that they can given the market environment, that's the economically rational thing for the bank to do. Now, does that mean that the bank is going to, but that means that the bank is going to have not a non-performing, but an underperforming asset on its balance sheet for an extended period of time, which is going to prevent that bank from being more active in the market because it doesn't have the cash. It's got this underperforming loan, right? Like it's borrowing money from the Fed at 5% and it's only clipping a coupon from this investor at 4 when it should be clipping a coupon at 8 from that investor.
Mm-hmm.
But it's rather than take a loss, rather than write off half the equity, or write off half the principal rather of that loan, it'll just clip the 4, right? Like it makes sense for it to just like clip the 4 and we'll just do less business, play more golf, clip the 4 and play more golf for the next 3-4 years until we work ourselves out.
And let the Fed backstop the rest.
Yeah, right.
All right, man. Well, great episode today. Just as a heads up to those who listen, and frankly, Jack, I'm kind of surprised. I've met several people lately via email who have reached out to me, as well as at IMN, who have said they're loving the show. So that's great to know. We've got some really cool episodes coming up. Jack sat down, I guess maybe over a bourbon or two, and sat down and wrote out like some really great guests that we can get on over the next several months, maybe for the entire year. So we're really excited to bring on a whole bunch of guests from all different walks of life, from attorneys to great investors in multifamily to realtors that we know, just really top-notch people that we're going to bring onto the show. So look for that in the new year. This will be probably our last episode. No, I think we're going to do one next week. Didn't we mention that? Yeah, yep. So not our last episode of the year, but I want to wish everybody a Merry Christmas. Merry Christmas, Jack.
You too, man. You too.
Thanks, brother. All right, we'll talk to everybody soon. This is Real Investor Radio. I'm Craig Fuhr. We'll see you soon. Merry Christmas.